Okay, so today is August 19th, 1920. So I'd like to call to order the meeting of our Investment Advisory Council. And we will skip the salute to the flag since we have no flag. So I asked the secretary to take roll call.
Can you guys hear me?
Yeah,
Okay, sorry, just wanted to make sure. Okay, I'm going to go ahead and take roll. Chairperson Richard Steinhoff,
here.
Vice Chairperson Nina Altuntash.
Here.
Commissioner Brent Cranmer is going to be absent today. Commissioner Elizabeth Pagliarini.
Here.
And Commissioner Edward Rosenblatt.
Here.
Thank you.
Okay. So,
Mayor Goodell is here too.
Great. Are there any public comments?
No, there are not.
Not, okay. So the next item is the consent calendar. Do any commissioners want to pull any items or have any questions on the consent calendar? If not, you need a motion to approve. Please state your name when you state your motion.
I make the motion.
I second.
Okay. Now, we're going to ask you to go one by one and just say your name and how you vote, okay? So, Vice Chairperson Nina Altovich.
Yes.
Okay. Commissioner Elizabeth Pagliani.
Aye.
Okay, Commissioner Ed Rosenblatt.
Yes.
Okay, the vote is unanimous, 4-0. Do we have a staff report?
So Jeff Probst from Asset Management is here to review our portfolio for quarter end 6/30 and give you an economic update.
Okay.
Good evening, Commission, and thanks for having me. I hope everybody is doing well and hanging in there during this crisis. Please let me know if you guys can't hear me. I can try to speak up as well. So from the last time we met, economic data has largely rebounded from the very, very depressed economic levels we saw during April and May. We did see, we have seen the labor market start to show some positive signs. We have obviously seen equity markets hitting record highs. The S&P 500 reached a new record yesterday, an all-time record. So things are recovering, though there is a little bit of disparity between the recovery. Equity markets are really showing a big recovery, while some of the economic pictures do not show such a robust recovery quite yet. So as we go through this, through the slide deck, I will point out some of those things and talk about how that is currently affecting the portfolio. I'm also going to try to do my best to, I know there's some time constraints, to make it a little bit more brief, as the data is still largely pretty poor. The Fed, which has a direct impact on the portfolio, is still doing exactly what it was doing 3 months ago. They have the federal funds rate at 0 and have very, very high goals in order to raise the federal funds rate any higher. They are really looking for inflation to creep back into the economy. We have seen some inflation coming back in, but still it's pretty far away from their targets of where they would like to see inflation. The Federal Reserve also is continuing purchasing very large amounts of Treasury and agency mortgage-backed securities to the tune of about $100 billion per month. So very, very large. They have purchased nearly $3 trillion worth of securities, about $800 billion of those being agency mortgage-backed securities. So very, very large amounts of money they have been injecting into the economy to stabilize markets and to try to achieve their goals through the monetary policy. The Federal Reserve will often, they say that we're doing everything we can, and they say this is the time for fiscal authorities to take over. And we have seen a little bit of hesitation in the fiscal side, the government of passing another, like a CARES Act version 2 that may extend unemployment benefits as well as, some other economic, benefits for businesses. The Treasury yield curve has really remained fairly constant over the past 3 months at very depressed levels. Roughly speaking, say the 2-year Treasury at about 15 basis points and the 5-year Treasury at around 30 basis points. So very low levels given where we were even just a year ago. Moving on to slide 4 and the employment report. Would you guys like me to share it, or does everybody have the report in front of them?
Yeah, it's in our.
Okay, great. Perfect. So on slide 4, we have the non-farm payroll figures. This is the big headline unemployment figure that comes out roughly the first or second week of each month. We saw the devastating roughly 21 million people leaving the labor market or losing jobs in the month of April. Since then, we've had a bounce back of roughly about 10 million of those people have received, we've had some positive reports, though that increase has started to slow down. We have last month, in July, it was about 1.7 million, and then in August, I believe the number was around 1 million. I don't have the data exactly in front of me, but that rate of change has started to slow. The unemployment rate is currently sitting right above 10%. That's coming down from where we were, roughly speaking, around 14 or 15% during the depths of the pandemic. That number, though, I feel is understated, as there are other parts of the labor market that are often not counted in these numbers, those such as private contractors, think Uber drivers or other people who have been part of the gig economy over the past several years. They are not captured in these headline numbers from the Department of Labor. And those are running, roughly speaking, about 10 to 12 million people that are out of work through the gig economy or through private contractors. So they are receiving assistance through the CARES Act, through a brand new program, and roughly that is about 10 million people are receiving additional employment benefits through that. On page 5, some of the more timely data, this comes on a weekly basis. It shows the initial claims as well as the continuing claims. Initial claims are how many people have filed for unemployment during the past week through their state offices. And then the continuing claims are those of how many people are currently receiving unemployment benefits. We've seen a nice trend down from the peaks of which has rolled off of this graph of about 7 million people in a single week filing for unemployment claims. We are now right around about 1 million. This number comes out tomorrow, and the market's really looking for something below 1 million. Continuing claims continue to decrease. That's a positive sign, but still at a very elevated level. Pre-COVID, the continuing claims were right around 3 or 3.5 million. And the initial jobless claims are right around 215,000. So even at 1 million of initial claims, that's still 5 times where we were pre-COVID. So there is still a lot of movement in the labor market, and with some of the headwinds in the economy, given the lack of additional fiscal stimulus, as well as the resurgence of COVID in July and still into August, there's still a potential of some problems. We're seeing COVID is very hard to get rid of. We saw UNC, University of North Carolina, as well as Notre Dame. They brought their students back to campus, and then they've quickly shifted them back to home. So, it's, as we go into the fall, it might be COVID might be a difficult virus to handle, as we get into the flu season as well. Looking at the consumer price index and personal consumption indices, these are their inflation figures that the Fed looks at. Both of these are well below that 2% target that they are looking for. When these inflation figures likely breach 2% and remain above 2% for a sustained period of time, the Fed will likely think about raising the federal funds rate. Currently, the PCE core index is right around 1%, and it's been stubbornly below 2% for some time. So we think that the Fed has a long, time horizon until they're going to theoretically raise rates again. Moving to page 7 in retail sales. Retail sales have recovered from, some of the really big lockdown months of April and May, and even a little bit of February of March. We see that it has recovered on a year-over-year basis in June, just a slight bit, but some of that can be pulled forward from, some of the disastrous figures that we saw previously. We're still looking at, what's going on with the fiscal stimulus with people receiving such enhanced employment benefits. We feel that a lot of that went into retail sales. Walmart recently reported earnings, and they said that they have started to see sales slow down in the past month or so, and that's really showing of those employment benefits rolling off, the extra $600 per week. Foot Locker, another funny one. They reported historically high earnings per share or earnings for the company and profits during this period. So people had money to spend, and obviously they were buying some athletic shoes. So there are these stories out there of consumers doing okay and at very specific places: Walmart, Target, Costco, etc. Places that remained open and available to consumers during this time period. Consumer confidence, I would still say, remains relatively high given what's been going on in the economy. We're in the mid-90s, and to put into context, this figure has dropped down into the mid to high 20s during the financial crisis. And so I think that the actions by the Fed, as well as the executive branch, as well as Congress, by passing the CARES Act, has allowed confidence to stay high. People have their income replaced with the increased benefits as well as stimulus payments. But now that has passed, and potentially we might not get the same magnitude of stimulus payments, we could see a pullback in confidence in coming months. The leading economic indicators on page 8 still remain, they have bounced back, but they're still at some depressed levels. These indicators we're going to look at more on a longer term basis, as some of these movements have just been historic in nature, and we want to look at them on a bit of a longer term trend. The Chicago Fed National Activity Index is still in recessionary territory. That is anything below negative 0.7, and it's roughly on a 3-month moving average, it's right around negative 3.5. So that did bottom out roughly below negative 7. So almost 10 times the level that the Chicago Fed thinks of as a recessionary indicator of negative 0.7. On page 9, housing starts and Case-Shiller 20-city composite home price index. Housing starts definitely took a turn down during the depths of the pandemic. Some of this is due to shortage of labor, the inability to actually build because of social distancing, and some of the home builders actually stopped doing the permitting process. They couldn't get things through the city to get permits and all that stuff, so starts were difficult to get going. We have definitely seen a rebound in this figure. This data was actually released earlier this week. It's not on this chart, and it really did show a pretty robust rebound. So housing has definitely been one of the areas that has been a shining light in the economy so far. People are looking to buy houses, given mortgage rates can be had for, under 3%. That, good credit, 2.8%, 2.75%. So people are finding the overall mortgage check to be an affordable one. The home price index is remaining high with, year over year, annual growth of roughly 4%. We do think that over the next few years, we may see some regional changes if the pandemic isn't fixed, or work from home actually sticks for a lot of companies. We could see an exodus out of some of those higher price areas. I know there's been some data out of San Francisco, even New York, showing that home prices have and rents have fallen in those locations. So something to keep an eye on. But housing tends to be more of a slow mover than some of these other indicators. Looking at manufacturing, again, still depressed, still coming off of depressed levels. We see the ISM index, the Institute of Supply Management Purchasing Managers. It has bounced back into expansion mode, coming off of a very low reading in May and April. So again, we want to look at the trend and not just a single data point. The trend has been downward sloping over the past 2 years. A lot of that is due to the trade war and the strong U.S. dollar, which has actually been reversing and becoming weaker over the past month and a half or 2 months or so. Industrial production still remains depressed. And then looking at GDP, I'm glad our data actually caught this for the report. The second quarter GDP was released in late July, coming in at about negative 33%. So again, a very historically large negative print on a quarter-over-quarter basis. We're in a recession, 2 consecutive quarters of negative GDP, but it was really driven by the personal consumption index or personal consumption expenditures, as well as overall investment. The economy went into basically paralysis for that quarter, but we do expect quarter 3 to have a positive rebound as many locations have opened up to some degree. I know San Diego County recently got off of the governor's watch list, I think yesterday. So there is some incremental benefits. It would be difficult to see another negative quarter-over-quarter print. Now, the magnitude of that increase is something to be watched. As the pandemic continues to fuel ahead, we were still seeing roughly 50,000 cases a day and about 1,000 deaths per day. I can't see us going back to normal quickly. So the longer this prolongs, the more damage and likely the future increase in the quarter 3 and quarter 4 growth will be diminished. But definitely we do think a positive reading will come from in Q3. Looking at the Federal Reserve, as I spoke about, the federal funds rate on the right graph is at 0. We don't expect that to be increased anytime soon. The Federal Reserve balance sheet has increased about $3 trillion over the past roughly 3 or 4 months, which is just absolutely enormous. The amount of stimulus that the Federal Reserve and liquidity is providing to the market is enormous. They have purchased corporate notes, very similar corporate notes that are owned in the city's portfolio. They currently own about $14 billion worth of corporate debt. This is the first time that they've ever purchased corporate debt, but they feel that their involvement in the market is one for stability and allows issuers to come to the market and issue debt so we don't get into a liquidity crisis where certain companies that are worthy of still being around may have some financing issues. So they think that they are providing an essential an impact to the market. On page 13 is the Treasury yields. The graph on the right shows the yield curve changes for the past 3 months and the past year. Over the past 3 months, there's been very little movement in the yield curve. It is basically stuck there, very little volatility. We have seen, here and there a couple basis points, but overall the yield curve is upward sloping at very low levels. When we look back from a year ago, we see rates, generally speaking, about 150 basis points or so higher across the yield curve. So there's been a big shift downward in rates. And the graph on the left really shows the trajectory of rates, really peaking in October of 2018 and then continuing down for the past 2 years, mainly as the trade war was going on, and then when the pandemic occurred. So that's the quick of the economy. I would be happy to entertain any questions, or else we'll just move right into the account profile, speak about what's going on there, and hopefully make sure all the members can meet their obligations, their time obligations. All right, so we'll move on to the profile. So this portfolio is really there to meet the needs of the city. If there's a case of needing liquidity, It's so safety, liquidity, and yield are the three tenets. So investing in very safe securities that are liquid in case there is a need, and then have a return that is commensurate with the risk being taken in the portfolio. We're going to hope to achieve a return greater than that of the benchmark through a market cycle by investing in all of the high quality securities that are allowed for within the investment policy of the city, as well as California government code. On page 16 is the compliance sheet that is sent to the city on a monthly basis, showing the portfolio complies with the policy as well as all government code laws. And then the portfolio, over the past 3 months, the portfolio's value has increased by about $150,000. Much of this is due to interest rates falling and the securities in the portfolio appreciating in value. The average quality of the portfolio remains very high. There's been no change over the past 3 months. It remains a very high AA rated portfolio. The average purchase yield, I would like to talk about the two yields. This is really showing why the value of the portfolio has increased. The purchase yield has decreased about 16 basis points, and this is due to us reinvesting maturities into the portfolio at much lower interest rates. The average market yield has, on the other hand, has fallen about 65 basis points during the same time period. So that's showing what's happened in the market. So interest rates have really fallen, but luckily the city has securities that were purchased, 2 or 3 years ago at much higher yields. So those securities may bridge the gap of low interest rates for some time, but sooner or later, those are going to roll off, and that purchase yield will start to come down closer to the average market yield. It's an unfortunate thing, but interest income will start to decrease if this interest environment sticks around for any real duration, 1 to 2 years. Looking at the composition of the portfolio, is very high quality, with about 60% of the portfolio in the U.S. Treasuries, government agency type securities, a healthy allocation to corporate notes that are diversified across issuers as well as industry types. But overall, a well diversified portfolio taking advantage of California code's available investments. The issuer list on page 19 really shows that the highest allocations are to that of the agencies and or the U.S. government directly. Roughly speaking, 60 or so percent, maybe even a little more if I do the math. The corporate notes we like to keep in a smaller piece size for diversification, and in the instance of any name gets into distress during this time period, it's not a super large impact to the portfolio. These position sizes are slightly larger than what we would typically have, but that was really driven by a portfolio withdrawal roughly about a year or so ago when we pared back some positions in the portfolio for the purchase of the golf course. On page 20 is the quality distribution. The majority of the portfolio is really AA rated. Those non-rated securities to the right would likely fall into the AAA category. It's just that we use S&P to make this table, and those securities are likely rated by Fitch and Moody's. So if we were to look a little bit deeper, those would likely move into the AAA category. Thus, this portfolio is very high rated. We have seen very little downgrades, credit downgrades from on the issuers which are within the city's portfolio. No issuer has a BBB rating, so we really feel that the portfolio has performed well during this time period. I'm going to skip to page 22 in the performance. The performance over the past 3 months, which is ending, this is ending June 30, 2020. The portfolio returned 1.24% versus the benchmark of 14 basis points. And over the past 12 months, it has returned roughly 4% versus the benchmark of 4.05. We are continuing to see good performance. I know we didn't have the time to get in the August or the July figures, but we continue to see the portfolio set up for strong performance, though it's very unlikely that we'll be able to repeat the 4% return because much of that was due to the decline in interest rates over the past 12 months, basically 2 years. Pretty soon we'll have a figure to fill in for that 2-year column once we pass through October, so we can see 12 months in the 2-year performance data. Moving further on, we have information that is provided from the city, their LAIF portfolio figures, and that's on page 23. This is showing that LAIF figures jumped up during that time period, likely due to property taxes. And then moving further on, we can get to a consolidated figure that shows the entire portfolio on page 26. So this is the combination of LAIF, other money market funds, as well as the portfolio managed by Chandler, showing that at the end of June, there was a total of $38 million in liquidity in portfolio and or LAIF. Very high rated, but again, that purchase yield is starting to come down. The average market yield is starting to come down as the portfolio, as well as LAIF, starts to reprice lower and lower. I believe LAIF is now right around 80 basis points or lower. So it is being repriced as they have to reinvest during this time too. Page 27 shows the diversification. On a whole, the portfolio is definitely dominated by the LAIF, and all of the other securities are a small fraction of the overall LAIF aspect. And then after that, we have all of the portfolio holdings, line by line, security by security, on page 29 and beyond. So I think I met the 5 o'clock cutoff there for member Rosenblatt. So hopefully you can stick around for some questions.
Yeah, I can stick around for a few more minutes and then I have to go. I'm sorry.
Go ahead, Edward. Do you have a question?
No,
You don't have a plastic bag?
I don't. This is the only bag Sherry.
Okay, thanks. Hello? Are you guys hearing me?
Yes.
This is Mayor Goodell. Are these slides available somewhere to see?
Oh, hi, Brian. Yeah,
Hi.
they're in our agenda package.
I didn't get that. Okay.
I'll get you a copy, Brian.
Thank you.
So, any commission have any questions?
No questions.
No questions.
No questions. Okay. Thank you very much.
All right. See you guys again in 3 months. Have a good one.
Okay.
Hi, Misty.
Thank you.
Okay.
Okay.
Thank
She
you.
said she wants to go there.
Okay. We did a motion to approve that Chandler report.
Motion.
I second it. I second it.
Okay. All in favor, give me your name and vote.
Liz Pagliarini, aye.
Ed Rosenblatt, yes.
And Nina Altuntaş, yes.
Richard Steinhoff, yes. So the motion carries 4-0. Next item is our investment policy review. Everybody had a chance to review that policy? Anybody have any recommended changes?
I do not.
That's section 8.
I don't see any changes required.
Okay. And I don't see any changes required either. So then we need a motion to approve. Who made a motion?
I motion to approve.
All right.
And I second it.
Nina seconds. Okay. All in favor, state your name and vote.
Ed Rosenblatt, yes.
Nina Altuntaş, yes.
Liz Pellegrini, aye.
Rich Steinhoff, yes. So motion passed 4-0. Okay, moving on to new business. Do we have a staff report? Cheryl?
Yes, you can hear me?
Yes.
Okay, so we're on item number 9, correct? The annual treasurer's report?
Yes.
All right. So basically, once a year at the end of each fiscal year, we put together annual reports for each portfolio just to provide a summary of what the portfolio looked like and what the portfolio performed for the year. And so we present to you the annual reports for the city, the Community Development Financing Authority, and the Mission Viejo Housing Authority. Again, it's a summary of what occurred during the year, so it's a reflection of what you've seen on a quarterly basis. So there should be no surprises, hopefully, in any of these reports. There isn't anything specific I want to focus on in any of these, but I certainly would be more than happy to answer any questions if you had any questions about any of those reports that we're presenting to you. But we're asking that you approve, that the recommended action is to receive and file these reports presented to you.
Cheryl, I have a question. How's the golf course doing? It just only shows to the end of last year.
Right. Well, the golf course is doing well. The performance and the financial accounting for the golf course will show up in our annual financial report as opposed to our treasurer's report. And so that information will come to you when we finish our comprehensive annual financial report, which we call a CAFR, later on in the year. But we did have revenues exceed expenditures for fiscal year 1920. And so far, so good. And we've adopted a new budget for 2021 with a number of appropriations provided for other improvements that we are actually already starting over there, including rehabbing the restroom, doing some slope maintenance and some other items. So things are progressing over there, and we've so far been able to do it within the revenue stream that's being provided by the golf course. So everything's looking good over there.
Thank you, Cheryl. Okay, so we need a motion to approve the financial report.
I motion to approve the report.
Good. Do you have a second?
Second.
All right. So state your name and then your vote.
Edward Rosenblatt, yes.
Liz Pellegrini, aye.
Nina Altuntaş, yes.
Rich Steinhoff, yes. So motion passes 4-0. Okay. Cheryl, do you have any additional comments?
No, not really. I mean, everything's just sort of moving along as usual, although a little bit unusual considering the times. We did adopt a fiscal year 2021 budget in the first meeting of July, which was substantially modified because of COVID and having to make modifications to revenues. But we were able to readjust the budget and balance it for fiscal year 2021, which is good news. I'm not sure if you're aware, but we did receive CARES Act funding through allocations provided to us by the county and then the state separately. We got one from each entity for a total of about $2 million. So while we didn't get a direct allocation because we weren't large enough to get a direct allocation, the county and the state did provide allocations to their respective agencies within their jurisdictions, which was nice. So Part of what we did is adopted CARES Act budget, also in the first meeting in July that went to the City Council, and it allowed us to move some funding that we would have had to provide for in our general fund. We were able to shift some of the costs associated with things we were going to need to do over to the CARES funding, which allowed us to free up some money in the general fund for other purposes. So that was helpful for us in balancing our budget for 2021 and also for 1920. So we do think we'll be able to expend all of it. We're required to expend it by the end of this year, so December 31st, 2020. And we think that we will be able to do that. So
That's great.
and I don't have anything further. So
Okay, thanks, Cheryl. Could we get a copy of that economic report to Brian Goodell?
yeah,
Sure,
we'll
I
send him
can
a
email
copy
that
of the
to
agenda. Yeah, he's not a member of this commission, which is why he didn't get it. But he's here for the Section 115 meeting that starts in, although I see he's dropped off, but it starts in a few minutes. So that was really what he was here for. So.
Okay. All right, so let's see if any commissioners have any comments. Edward? Did he leave? Yeah, okay.
No, I'm here.
Okay.
No comments from me.
Okay, we got it done as fast as we could.
Yeah, thank you so much.
So
I gotta get going.
go to your wedding.
Everybody stay safe, okay?
All right,
Okay.
thank you.
Thank you.
Bye-bye. Thank you.
Okay, Vice Chairperson Nina Ackley.
Yes, no comments. Thank you
No.
so much.
No comments. Commissioner Elizabeth?
No comments, just thanks to everybody.
Yes, I have no comments either. And thank you all for coming.
Thank you. Have a very safe rest of the year until we see each other in November.
November, right.
Yeah.
Thank you.
This is the mayor. I just wanted to say thanks to all you for your work.
Thanks,
Thank
Brian.
you, Brian.
Thank you.
Thank you.
Sorry, I got disconnected there for a little while.